Enterprises India Limited Q2 and H1FY22 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectation of the company as on the date of this call. These statements are not a guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Daljit Singh, Managing Director of Amber Enterprises Limited. Thank you, and over to you, sir.
Hello and good morning, everyone. First and foremost, I hope you all are keeping safe and healthy. On the call today, I am joined by Mr. Sudhir Goyal, Chief Financial Officer, Mr. Sanjay Arora, CEO, Electronics Division, Mr. Sachin Gupta, CEO, RAC and CAC Division, and SGA, Investor Relations Advisor. We have uploaded our results presentation on the exchanges, and I hope everybody had an opportunity to go through the same. I would open my remarks by giving a brief overview on the industry environment, followed by business update and operational and financial performance highlights for Q2 FY22. With India's scripting history of 1 billion vaccination mark, a lot of confidence is coming back post-pandemic, which should help in more stable and conducive operational environment. During the quarter, sales of consumer durable goods have recorded sharply as the restrictions to stem the pandemic's second wave were eased. The consumer sentiments were encouraging during the season. On the channel inventory, there has not been much inventory in the channel due to strong supply chain planning in line and ban on refrigerant-filled AC announced last year, which led to increase in domestic procurement by the brands. On the raw material side, there have been challenges due to increased input prices of key raw material. Higher raw material prices have led to increase in prices of finished goods. However, this has been well accepted by the end consumer and had no significant impact on the demand. Talking about the recent updates, during the quarter, we had applied for government-notified PLI scheme. We believe the additional manufacturing capacity coming under PLI scheme would have huge multiplier effect and help build a robust supply chain network for the AC industry. The main objective of government for the scheme is to develop component ecosystem in India and increase domestic value addition in components from 25% currently to 75% in next 5 to 6 years. This is going to be a very big game changer for component ecosystem. At Amber, we are all set to leverage on this opportunity. We believe this opportunity will further strengthen our presence in the domestic market and create a solid foothold for exports market. We have been seeing a good traction on customer addition due to ban on imports with refrigerant-filled ACs. We have signed new customers for gas charging in the first phase during last season. Now the discussion on the second phase has also started with them for OEM-ODM solutions. On the export side, we have opened 100% US subsidiary Amber Enterprises Incorporated USA, and approval process for our products is on track. At Amber, we are all set to leverage on multiple opportunities. Our endeavor is to grab majority of the market share on RAC and component side. We believe this opportunity will further strengthen our presence in the domestic market and create a solid foothold for exports market. I will now take you through consolidated financial highlights. Q2 FY22 revenue stood at rupees 587 crores versus rupees 408 crores in Q2 FY21. H1 FY22 revenue stood at rupees 1295 crores versus rupees 667 crores in H1 FY21. For the quarter, RAC contributed 37% of total revenues, while components and mobility application contributed 63% revenue. For the H1, RAC contributed 52% of total revenues. Operating EBITDA Q2 FY22 operating EBITDA stood at rupees 39 crores versus rupees 22 crores in Q2 FY21. H1 FY22 operating EBITDA stood at rupees 88 crores versus rupees 19 crores in H1 FY21. Operating EBITDA margins for Q2 and H1 FY22 stood at 6.6 and 6.8% respectively. Q2 FY22 and H1 FY22 operating EBITDA does not include ESOP expense of rupees 4.17 crores and rupees 7.43 crores respectively. PAT Q2 FY22 PAT stood at rupees 8 crores versus rupees 3 crores in Q2 FY21. H1 FY22 PAT stood at rupees 19 crores versus loss of rupees 21 crores in H1 FY21. Now I'll come and update for the subsidiaries financial. In Sidwal, Q2 FY22 revenue stood at rupees 72 crores and Q2 FY22 operating EBITDA stood at rupees 17 crores. H1 FY22 revenue stood at rupees 121 crores. H1 FY22 operating EBITDA stood at rupees 29 crores. There have been a lot of opportunities in the mobility application industry, which are expected to play out over a longer period. The country has 733 kilometers of operational metro rail line in 18 cities, with another 1046 kilometer of network in pipeline 27 cities. The Rail Ministry targets to connect 50 cities and towns with metro network by 2024. Also, the government is increasing on the number of rail coaches being added along with the percentage increase in AC coaches. With the increase in government thrust towards mobility for all, we believe we are in sweet spot to leverage this opportunity. Sidwal order book stands as healthy at more than around rupees 450 crores. PICL Q2 FY22 revenue stood at rupees 40 crores. Q2 FY22 operating EBITDA stood at rupees 3 crores. H1 FY22 revenue stood at rupees 76 crores and H1 FY22 operating EBITDA stood at rupees 7 crores. As per industry data, currently 70% of BLDC motor is imported. At PICL, we would like to capitalize on this opportunity, and we have already done R&D and required capex, and work has also started. During the quarter, we have enhanced our BLDC motor manufacturing capacity. Our endeavor is to provide solutions for both captive users and our customers in exports. We are in advanced talks with few large OEMs for BLDC motors and also exports in US. Ilgin and Ever Q2 FY22 revenue for Ilgin and Ever stood at rupees 91 crores and rupees 50 crores respectively. Q2 FY22 operating EBITDA for Ilgin and Ever stood at rupees 2.7 crores and rupees 3.5 crores respectively. H1 FY22 revenue for Ilgin and Ever stood at rupees 134 crores and rupees 68 crores respectively. H1 FY22 operating EBITDA for Ilgin and Ever stood at rupees 1 crore and rupees 3.7 crore respectively. As the market is moving rapidly towards inverter ACs, we are confident of growing our revenue share from Ilgin and Ever going forward with help of our in-house developed inverter PCBs for IRAC. To conclude, I would like to reiterate that our constant endeavor would be to increase penetration and increase our wallet share in the existing customers, continuously add new customers, create a foothold in the exports market, and enhance our products with new technologies by focusing on R&D. With this, I open floor for discussion.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask any question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may please press star and 2. Participants are requested to use handset while asking a question. To ask a question, you may please press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Ankur Sharma from HDFC Standard Life Insurance. Please go ahead.
Hi, good morning, Jasbir-ji. Thank you so much for your time. I had a couple of questions. One, on the standalone, if you could just share AC volumes which was sold for Q2 And also for the full year, how are you looking at volumes? Do you think you can kind of come close to the full year FY20 volumes, or can you, kind of exceed that number for FY22?
So in quarter, we did around 231,000 numbers. And on H1 basis, we did a volume of around 700K. And if you see, the second wave of COVID hit us in the first quarter. Earlier, brands were left with inventory, and everybody was envisaging a third wave also. However, with the third wave risk reduced, inventory levels have come back to normalized levels, and consumer sentiment is also back. Our order book for upcoming quarter stands very strong, and we are confident of achieving more than 3 million, which is what pre-COVID levels were actually. So looking into the whole scenario right now, we are very, very confident of coming to pre-COVID levels and in fact overachieving the pre-COVID levels.
Okay. And sir, what would have been the price growth? So, overall standalone revenues are up 55%. And I guess the volume growth would be about 22-23% if I get the numbers right. So 231 versus maybe 190 or last year. So the balance for 20-25% is the value growth. Is that or?
So both, yes, because there has been a huge hike in the commodity prices, and of course, as Amber, we have been successfully able to pass on all the commodity prices to our customers. And due to that, you see average selling price increases, and the commodity price, if you see, has increased in tune of almost around 12 to 13% for that quarter. And looking into that, you'll see that the price, average selling price, is elevated due to the commodity price changes.
Okay. And have you been able to completely pass on, or do you think you need more price hikes to kind of, completely pass on the cost increases? Because the margins are pretty well looking good, right, at the gross level.
Yeah, so for each quarter, we have been able to successfully pass on the price hikes with the lag, because we have a quarterly lag pricing system with all the customers. However, looking into the future, as and where the price hikes are coming, we are hopeful and we are confident to continue increase the price and pass on the price hikes with our customers, because that's how all the contracts are placed today, with the price variation clause with our customers. So we see not much dip. There could be a quarter lag, but not much dip due to the commodity price increases.
Thank you very much. Mr. Sharma, please come back in the queue. And in the interest of time and fairness to all participants, please restrict your question to 2 per participant. The next question is from the line of Swati from ADV Partners. Please go ahead.
Yeah, good morning, DG. Just wanted to ask a question, regarding the debt levels of the company, like gross debt and the net debt levels for this quarter.
So total net debt level is at the standalone level is 155 CR as on 31st March.
Okay.
And at the console level, it is 250 crores.
Okay. And gross debt?
And the gross debt is 747 crores at a console level and 625 crores at standalone level.
Thanks a lot.
Thank you very much. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Good morning, and thanks for your comments on the industry. Just one question. I think I would ask in talking about your volume, how one should look to a COVID level. But just on a broader basis,
Nitin, sorry, but you are not audible very well. Can you speak a little louder?
Yeah, sure, sir. I'm audible now, sir?
Yeah, better now.
Okay. So the question was, sir, that on a 2-year CAGR basis, your growth, and I'm talking specifically standalone, or let's say look at the industry CAGR is still down on a 2-year basis. And you can tell me because you know better data than us. So, is there attributed to market share loss, or you think it's more of a supply chain issue which hampered some player for a few quarters here and there, and which should not be reflected in the future? Just need your comment on that. And second, exports. Can you help us a little bit understand where we are in the stages of development? So the question is, I understand because in the last 3-4 quarters we are talking about, the product has gone for approval to a large client in US. But if you can throw some light where it is stuck, it's more of queries coming from that side on the product. It is more reworking that you need to do, and then it can take time. I just need your comment on these two. Thank you, sir.
Sure. So, Nitin, to answer your first query about the volumes, so there is no market share loss over here. It's more about because the second wave of COVID hitting us in the first quarter. Due to that, there was a lot of inventory stuck in the channel. And everybody was waiting and even envisaging that there would be a third wave, and everybody was pretty pessimistic. But overall, if you see now with even the price increases which has happened, and right now the markets are completely open and back to normalized level. The channel inventory is now back to normal level. At the same time, consumer sentiments is back, and so is our customer sentiments. Our customers have already booked placed strong orders for the upcoming quarters. So we see that yes, there was a quarter here and lag because of the second wave hitting us, and all the supplies were halted. But at the same time, now it is back to normalized level, and order book for upcoming quarter is very strong, and we foresee that we would be reaching to pre-COVID levels on the yearly levels, basically. Secondly, to answer your export, in exports, as we have already submitted our samples, as well as, each and every country have their own regulations. And those regulations are not similar all across. So every country have their own regulation, energy efficiency ratios, as well as the safety regulations. So it's a high approval cycle. So it should take another 1 to 2 years, 1 to 1.5 years, I would say, before the exports start kicking in. So our samples are already now under approval cycle and under reliability cycle. And looking into that, I would say another 1 year, 1.5 years down the line, we would see the orders coming in from the customers. On the motor side also, we are looking at exports. There we are little ahead, where 2 large OEM sides from US are pretty interested, and our reliable cycle is almost near to closure. So we would see purchase orders coming in probably first quarter of next financial year instead of next 1 to 1.5 years. So there we should start cracking the numbers pretty soon. So that's an export update.
Thank you very much. Anyone who wishes to ask any question may please press star and 1. The next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Thanks for taking my question. Sir, I had a question with respect to working capital. So we see that your cash flow for the first half has been negative. So if you could just throw some light on, what have been the changes there, and, how do you see this normalize?
So our working capital days have improved from 135 to 84 days now, and we are pretty vigilant on the working capital. The supply chain all across the world is disrupted, but however, we are, confident that the supply chain getting smoother as we move forward, and this is expected to further come down to the pre-COVID levels as we move forward.
Okay, sir. And I had a question with respect to, the captive consumption of, say, your other subsidiaries in your OEM business. So if you could just throw some light on, how much captive consumption do you expect of these components, say, in the upcoming season and, say, in FY23?
So in components, we are seeing a great traction on the customer side also. So if captive consumption will continue to go on today.
Hi, this is Sudhir. So captive consumption during H1 was around 23 crores, and it will be in the range of around, it could be like 60-70 crores by year end. It could be more as the brands will start buying inverter ACs and motors from our subsidiary, which will be transferred to the Amber and then ultimately sold to the brands. So currently H1 it is around 23 CR.
If I can squeeze one more question here, sir, just wanted to get your sense on how do you see your market share, in the RAC segment, in FY23. I know in FY22 and 21 we've seen supply chain disruptions, but on a more normalized basis, how do you see your market share moving from FY20 levels?
So Dhruv, we see that we should be able to increase our market share because on account of, if you see, one that we are coming up with 2 greenfield facilities already, which are strategically located, one on the west side and one on the south side. So which would definitely help us grab more market share from our customers. Second is also that many of our customers which came on board due to our gas charging basically as a phase 1. Now we are already in discussion phase to convert them into OEM and ODM solutions moving forward in the coming financial year. So we see that our market share should grow further, and we are confident of achieving that.
Thank you, sir.
Thank you very much. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thank you so much for the opportunity. Sir, just one element in terms of if you look at your overall volume, number of that 3 million odd units, which is broadly back to FY20. Also, you had done about 3 million odd units. Now, if you look at it, there's some amount of market share gain, as you mentioned, because of the non-tariff barrier which has been imposed. So would industry be still down on a volume base on a 5 to 10% on a 2-year basis? Would that be the right assumption? And you are just going back to pre-crisis levels just because of your market share gains. If you can just give us some thoughts there.
So on the industry perspective, if you see, Abhishek, that the markets are coming back to normalized level. And yes, there was a dip due to, of course, the pandemic. However, we are hopeful that this year the market should be somewhere around 6.5 to 6.8 million numbers, which would be near to pre-COVID levels. But as we move forward, the 2 years market, the consumer sentiment is very high. AC is no more a luxury product, and it's a more of a comfort living product right now. And with the new normal of working from home, obviously, more and more ACs are penetrating into homes. So we are hopeful that market should come back to its normalized growth level of 13-14% from the next financial year, hoping there is no third wave coming. So and so would be, of course, Amber. As Amber, we have always endeavored to grow our market share as well as outnumber the industry. And we are confident of achieving and keeping the same endeavor of outnumbering the industry.
So the overall that 400, 500 bits higher growth in the industry, you would maintain that.
Sorry, come again, Abhishek.
So your growth higher than the industry growth rate in that region of 400 to 500 bips higher than if industry was to grow at 10%, you will go at 15%. You will maintain that going forward is what the outlook is.
Yes, we definitely maintain that, and in fact we are confident more as components are also gaining a lot of traction due to PLI year-on-year basis. Yes, we are confident, and as well as we are adding more and more customers in phase 2 of refrigerant ban. We would be adding a couple of ODM customers and converting them from the gas refrigerant filling to the OEM solutions basically. So we are definitely confident and maintaining the 4 to 5% outnumbering the market.
Okay. So two other questions. If you see the operating margins of ILJIN still seems to be quite low at about 3% even for the current quarter. How should one look at that? Because ILJIN used to, has been in that, used to earlier was doing about... Hello?
I'm sorry to interrupt you. Please come back in the queue.
Okay, thanks.
Thank you very much. The next question is from the line of Madhav Murda from Fidelity Investment. Please go ahead.
Yeah, Mr. Jasbir, good morning. Thank you so much for your time. I just wanted to understand from you that on the PLI side, now that the applications have been filed and probably the winners of the PLI will be announced in the next few weeks, how do you see the manufacturing landscape for ACs changing in India with the PLI coming in, considering that there have been few brands who have applied and of course we've applied for the PLI as well. So in terms of sort of getting more traction with companies, with customers, how do you see that playing out?
Hi Madhav, this is Daljit this side. Madhav, we see this a great opportunity, like brands obviously which already have their manufacturing facility have also applied in PLI. But we don't envisage any shift in competitive landscape due to this PLI. Like we have already added, 4 new customers on the component ecosystem, as PLI is primarily based upon due to the component ecosystem, to create the component ecosystem. So today 75% of the components are imported, and it's a government's endeavor through PLI they want to achieve and bring it down to 25%. And we as Amber are rightly placed in a sweet spot. Fortunately, our both greenfield facilities are also covered in PLI, and approval list of PLI will be disclosed by DPIIT by around 15th November. So we are hopeful that we should be there and we should get approval, and we should see a great opportunity as we move forward on the component as well as the finished good side of the business, both sides.
And do we see import substitution or export for some of the components getting reasonably accelerated once the PLI related benefits of 4 to 6% start accruing to us?
Yes, I mean in PLI we have seen like a lot of commodities, like a lot of people from components which are right now imported, such as compressors and copper, aluminium, that being localized post PLI. However, it will take another 2 years because these are high capex, high intensive components, and it will take another 2 years for everyone to bring it localized and start selling in local market, made in India and made for India. But yes, we see that that's a great opportunity, as well as that getting localized will help us being more competitive in the export side of the world also, because then everything would be localized and there would be no freight components, as well as local manufacturing will obviously bring in more and more numbers and help the component ecosystem to be created also here in India.
And the second question from my side was...
I'm sorry to interrupt you. Please come back in the queue. In the interest of time and fairness to all participants, please restrict your question to 2 per participant. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. Sir, I have 2 questions. Firstly, on the client additions. Now you spoke that the order book for RACs is quite strong over the coming quarters. So any updates you would like to share in terms of client additions for both the RACs and the components and the potential upside that you foresee in the coming fiscal years as well? And my second question is on the supply chain, sir. This was just an extension to the earlier participant's question as to what is the current supply chain, how much of that is imported, and what's the extent of our backward integration which can help us have a moat against our competition. Thank you.
Thank you, Sonali. So, Sonali, on the client addition, I won't be able to disclose the names due to our NDA in place with all the customers. However, I would like to just update that on RAC segment, we have already been able to convert the two customers, large size customers, in this fiscal year only. They have started from refrigerant ban to the local ODM manufacturing, and we are already in discussion with four customers to be converted from OEM to ODM. This will add additional 800,000 numbers to our kitty as we move forward on the next financial year. On the component side, we have already added 3 customers, and 1 customer is already we are discussing. And this is primarily based upon the heat exchangers and the plastic molding and the sheet metal solutions as components which we provide. And both the customers, the production shall be starting in Q4. However, that would be a ramp up, and we would see that impact of the same coming in next financial year strongly. On the supply chain, if you see today as industry, we are importing almost 75% of component, and primarily based upon that, most of it is compressors, inverter PCB controller, motors, and copper and aluminium. Out of this, if you see, Amber is already present in inverter controller board, already present in motors, and like BLDC motors, 70% of BLDC motor is today imported. Now, Amber has already, its subsidiary PICL has already enhanced the capacity of BLDC motor, and we are rightly placed company, and we are already in the reliability cycle with a lot of customers whom we are already giving solution of induction motor. So there we would be able to add the BLDC motors as components. Similarly, on the inverter PC board, also a lot of inverter PC boards is imported into the country today. And ILJIN has already developed the inverter PC board. We have already got approval from 2 of the customers and large size customers, and we are hopeful to add additional 2 to 3 more customers in manufacturing of inverter PC board. So as Amber, we are in a sweet spot to capitalize upon this PLI as well as on this localized push from the government on the supply chain side.
Thank you, sir.
Thank you very much. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah. Hi, good morning. Thank you for the opportunity. I have 2 questions. First, if you can help us understand if there's any specific reason why ILJIN margins are still lower than the usual levels of 6 to 7%, despite strong volumes. And what would be the update on the commercial RAC portfolio that we were trying to drive? If we can have some more inputs on that, that would be helpful. And also, if you can share the EBITDA value for Sidwan.
Sure. On the on the ILJIN, on the operating margins of ILJIN, if you see, this is primarily based upon due to the mix of the solutions which ILJIN is providing. Like ILJIN provides a lot of solutions, a lot of PCB controllers for inverter to refrigerator to washing machine to television. So it is more likely more because of the product mix. The reason is because of the more product mix change. However, on the year-round basis, like with inverter controller board coming into picture as well as on the year-round basis, it should be on the similar side only. On commercial RAC, to answer your question, it has gained a lot of traction. We have already launched our entire product lineup of commercial ductable ACs as well as cassette ACs also. And we have already got a lot of queries from customers, and we are hopeful to, again, there is a reliability cycle. 2 customers production has already started. Additional 2 customers are in pipeline right now, and that would kick in next financial year. Our cassette AC range, which we have recently launched, has also started under reliability from our customers, and that would be pretty much launched. It should get approval by last quarter of this financial year, and hence the production should start in last quarter and full-blown production within next financial year.
So for next fiscal, what is the estimated size of RAC portfolio that we are targeting?
Sorry, Renu, can you come back again with the question?
I'm saying for FY22, what is the approximate size of the RAC portfolio that we are targeting? Commercial RAC portfolio.
So commercial RAC portfolio, we are anticipating, around 30 to 50 crores of revenue coming from there. However, it's a slow start. We are hopeful that it should reach to around 100 crores in the coming 2 years as we move forward.
Sure.
Thank you very much. In the interest of time and fairness for all participants, please restrict your question to 2 per participant. The next question is from the line of Naval from Emkay Global. Please go ahead.
Yeah. Thank you for the opportunity, sir. I have 2 questions. First, the way you have stated in your presentation about PICL in terms of outlook to double the revenues. So can you put the same comment for ILJIN and Ever if that is possible?
So in ILJIN and Ever also we are hopeful to almost going near to double the revenue in next 2 years. As the traction is very high over there, specifically also due to the PLI, and ILJIN is a rightly placed company to give that solution. We are already getting queries and already onboarded for inverter PCB boards, as I mentioned. In addition to that, we are also getting a lot of queries and approvals are already in process for refrigerator and washing machine and other new products also. So we are hopeful that in ILJIN and Ever also we would be doubling the revenue in coming 2 years from now.
And with margin expansion as well.
Of course, this will be coming with the margin expansion only. That is one of the important aspects.
Okay. And second question is on RAC realizations. What you stated that because of the commodity price increase that has kind of gone up to beyond 9,000 rupees. Now, this would also include the impact of somewhat from gas refilling and product mix also. Is that understanding correct?
Sorry, can you speak again, Naval?
So I'm saying in the realization part, which has gone up beyond 9,000 rupees now, you stated that it is on account of the commodity inflation what you have passed on to the customers. Now, this would also include product mix improvement and some benefit coming in from the gas refilling as well. Is that understanding correct?
Yeah, I mean, the majority of RAC realization right now is because of the, commodity price increase, because there has been a substantial increase in the commodities. And yes, also there is a product mix change also. Gas filling is not included in this.
So gas filling would be in components or non-AC components?
Yes. As that is still not in the ODM solution basically. As we move forward, that would be included then further.
Got it. Thank you so much and wish you all the best.
Thank you.
Thank you very much. The next question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Just have a couple of questions. One is with respect to the BE norm implementation, when it is likely to be for ACs and how we are preparing for it.
So Ravi, BE norms have been already extended by 6 months. And they would be implemented now from 1st July onwards. That clearance from BE has already come. And but as industry as well as Amber, we are already ready because they were supposed to be launched and implemented in January. However, there are few clearances required, and that is why there is a change. And BE has agreed to move forward to launch it implement it from the next financial year in July onward.
Got it, sir. And will there be any price increase associated with that norm change?
Yes, there would be a price increase, of course, because as the norms and energy rating would be changing, there would be additional impact. Should be additional impact of around 8%. I would say 5 to 8%, and the industry is already working towards how to mitigate it, basically.
Got it, sir. And the next 2 years CapEx forecast for us, if you can tell.
So the capex for like this year, we are envisaging around 400 crores, and next year we would be somewhere around 300 crores on year-on-year basis. Basically, this would include the maintenance capex, as well as this would include the new greenfield facilities and capacity enhancement.
Including the PLI related.
Yes.
Okay. Yeah.
Thank you very much, sir. The next question is from the line of Srinidhi Kalekar from HSBC. Please go ahead.
Yeah, hi. Thank you for the opportunity. I have a question on BLDC and induction motor. Sir, would it be possible to share what percentage of your captive need of both BLDC motor and induction motor comes from Amber's own subsidiary, which is PICL? And sir, how much volume are we talking about in terms of for a 3 million volume we are likely to do for this year? How much is like in number terms need of motors?
So currently in PICL, Amber contributes to somewhere around 35% as captive consumption, and rest all is customers. And BLDC is a very small part of it because that is a part which we just recently started. However, as we move forward now, expansion of BLDC is already in place, and reliability cycle is going on. It would take another 3 to 4 months for it to start in production completely. So we see that BLDC would be adding as revenue from both sides in captive as well as also on the component solutions to our customers.
Right. And sir, you said 35% of PICL's demand comes from own consumption. I wanted to know, like, what much of captive demand of Amber comes from PICL, the other way around.
I'm not for this.
Yeah, so the 3 million ACs you manufacture, right? Both indoor and outdoor units include both indoor and outdoor combined. So the need of those motors, how much comes from PICL? That number I wanted. Because some of it
only. It's 1/3 only actually, if you see. Because
we divided. 1/3. Okay, sir. And sir, how has that number changed over last couple of years?
It's pretty much the same. It might have increased from 28 to 35%. And it was earlier 28, but with BLDC coming in, it has increased. However, we are maintaining now at around 35% as the BLDC is kicking in, as the more and more product lineup is increasing in PHL.
And sir, as the reliability starts improving and you get more and more approval, realistically, can one expect that this number could go as high as 70-75%?
No, you are talking about captive consumption?
Yeah.
Captive consumption, no, it would be de-risking. Basically, Amber also moves as PICL, of course, as a supplier partners relationship, and of course there is always a risking and de-risking supply chain strategy in place. So it might increase to maybe another 2-3% or 4%. But however, we have other suppliers also where we buy motors from. And they are present in India, and we are looking at more and more localization of the same also.
Thank you very much. Mr. Kalekar, I would request you to please come back. Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good morning. Thank you for the opportunity. I have two questions here. Firstly, pertaining to the BLDC motors, what is the current production capacity that you have, and post-expansion to what volumes it will reach? And second question is more from the mix perspective. Given under the PLI scheme, we would see a lot of investments happening locally for components. Would this mean that our revenue share would tilt more towards components and would offset any operating leverage benefit that would get, thus stating probably margins have limited scope for expansion from here?
So to answer your first question about the BLDC expansion capacity, so currently we had very hardly any numbers were produced. It was just more about reliability and giving samples to our customers and getting approval of the line. Now the capacity expansion has been done, and we are at a capacity of almost around 2 million BLDC motors as we move forward. Currently, we would be at around, around 800,000 BLDC motors we can produce as we move forward. So there is a huge, as BE rating norms are also coming, definitely there the BLDC would be required. So as PICL, we would be aligning more and more towards this strategy and expanding our BLDC capacity as we move forward also. And regarding sorry, what was your second question, Sandeep?
Yeah, so it was regarding the margin trajectory, given sales mix will not tilt towards components going forward with the PLI scheme investments coming in.
So in that, we see that as a great opportunity. PLI is a great opportunity because if you see, more and more traction is coming from brands to localize. And there's a great opportunity for us to, on the component side is higher margins. So we see that that margin expansion would happen from the component side also as we move forward into the PLI ecosystem. And as Amber already, we are discussing with our customers and we have already added new customers, 4 new customers on the component ecosystem. So the component base would also increase as we move forward in Amber.
But margins could be higher in RAC ODM, right, versus components. So.
Yeah, hi Sandeep, this is Sudhir. So margin is better in components, but under PLI scheme, the captive consumption is also allowed. So it will be very difficult to see that how much component margins are inbuilt in the AC manufacturing. Right. So margins will be yes higher in components, but it gets merged in the AC volumes or AC sales.
Okay. So you are trying to say your margins in components are higher than what you make in ODM.
On the ODM solution, completely. See, ODM. What is ODM solution? It is component in-house manufacturing as well as the assembly. So in assembly, there is a compressor component which is a high value item, which reduces the percentage margin in the ODM category as compared to the margins which are there on the component side.
Okay.
So if I talk about the percentage margins are better in components as compared to the fully finished AC assembly selling.
Understood. Thank you.
Thank you very much. The next question is from the line of Manoj Guri from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So a couple of questions. First, if you look at a couple of your larger clients have been announcing the new expansion plan, and there are a few clients who are almost close to finalizing their expansion plan, and they are also applying for the PLI scheme. With this regards, if you look at, they might be planning to build a component ecosystem as well. So if you look at the new client addition, you said like they would be adding roughly around 800 to 1,000 units of 100,000 units of components in volume terms. So that would be roughly around 3%, 3.5% of FY20 volumes. So your clients are already expanding their capacity, plus you have been guiding on the market share gains. Can you elaborate a bit more in detail? That would be very helpful, sir. Thank you.
So Manoj, clients adding the new, expanding their own capacities is a great opportunity for us from the component ecosystem. And today also we are serving all our customers from different locations for their component need. And when they expand the capacity, more and more components would be required, and hence Amber can give more and more solutions to the customers and their and clients. Additionally, if you see, as Amber, we have already initiated 2 greenfield facilities, one in Supa side and one in down south. And there are many customers who are not expanding and who are purely on ODM. They would get benefit out of it as a logistically, advantage, and more and more capacities would be required, and they would be using our capacities as we give them logistically advantageous position from that perspective. So we are hopeful that we should be able to increase more and more wallet share within our customers as we move forward. Thirdly, as I mentioned that, in the phase one of the non-tariff barrier, which is refrigerant ban, we started the gas charging for our customers. However, as we move forward, we have already started discussing, and one of the two customers have already now, we have started giving solutions, and the remaining two we are already discussing to convert them into the ODM solutions. And that would add additional 800,000 numbers to our RAC volumes as we move forward into the next financial year.
Right, sir. But my question was regarding, obviously your clients would be sourcing a lot of components, but they would be setting up their own component ecosystem as well. If I'm not wrong, correct me if I'm wrong. So, doesn't in any case, it hurts us, or probably, I'm just trying to understand the situation. It would be great if you can help me understand this.
Yeah, so not all customers do 100% in-house component manufacturing. So there are some customers who do heat exchangers, some customers do injection molding, and not all customers do 100% in-house manufacturing. So more and more customers expand their capacities. There would be more and more components required, and we would be like sheet metal and motors and PCB inverter board. These are all the components would be required by a customer as they expand their capacities.
Thank you very much. The next question is from the line of Rahul Soni from SMIFS Limited. Please go ahead.
Hello. Thanks for giving me an opportunity. Sir, the volume which you have done so far in the first half, and you have good order book from your customer side. So going forward, what kind of ODM mix do you see for FY22 compared to FY21? And also, what's your thoughts on FY23 over this ODM mix going ahead?
So, as Rahul, as ODM, today also we are doing almost around 95% is ODM, and we are hopeful that we'll be maintaining the same as we move forward in the next financial years. And the numbers, as we always maintain, that we would be outnumbering the industry, and that endeavor remains the same, that we would be outnumbering the industry in coming financial years, also looking into how Amber is ready to give the solutions to our customers from various geographies in country, and at the same time, in coming financial years, the exports getting added to the kitty.
Okay. Sir, my second question on just two data points. What's your maintenance capex and your cost of fund?
Hi Rahul. So our cost of funds is between 5 to 6%, including long term and the short term. And if I talk about the maintainable capex, so maintainable capex for at a console level will be in the range of 80 to 100 CR. Looking into the various number, more than 15-16 plants, and plus addition of new greenfield facilities. So maintainable capex going forward will be in the range of 80 to 100 CR.
So this 5 to 6% cost of fund you said, what was the comparable figure for FY21?
For FY21, it was between 6 to 7, and prior to that it was more than 7%.
Okay, sir. Thank you.
Yeah.
Thank you very much. The next question is from the line of Madhav Mehta from Fidelity Investments. Please go ahead.
I just wanted to check that our capex guidance was for about 700 crores for the next 2 years. It seems like it's gone up versus what it was earlier. Is it because of more improved visibility for order book and sort of revenues? Is that why it's gone up, or there is any other factor?
No, you're talking about the capex.
Yeah, the
capex remains the same as from the perspective of the greenfield facilities which we are bringing. However, yes, there has been a slight commodity increase, as you know. In tune of that, yes, there would be some impact, but however, we maintain the same around 300 odd crores year-on-year basis on the 2-year basis, basically, as we mentioned.
So sir, basically we're spending 400 crores in FY22 and 300 in FY23. So a total of 700, of which I think maintenance capex should be about 150 to 200 crores combined. So that leaves up with about 500, and then 400 crores is for the two greenfield plants, right?
No, see, I'll explain. So for the two new greenfield facilities, the capex is between the range of 275 to 300 crore. Balance is the maintainable capex across all the subsidiaries and including the existing plants of the Amber. For the next year, it will be within the range of 200 to 300, depending upon how the growth is there in the industry. So sir has given you a number of the higher side, but it will be in the range of 200 to 300 based on the industry growth, because we will be needing some capacity enhancement across various plants, including the component side.
Okay, got it. And second question was that when we say that we want to double revenues for PICL, ILJIN and Ever in the next 2 years, what year are we taking as base? Is it the pre-COVID base of FY20 or is it FY21?
Yeah, it's a pre-COVID base of FY20. We'll be growing doubling our revenues in both the entities. PICL as well as ILJIN combined.
So by FY23, we want to be at double the revenues of FY20, right? Effectively, that's what you think.
So either 23 or maximum 24.
24.
Because still the industry has to come to a normalized level, to a pre-COVID level. So we have to see how the industry can come to that level. But yes, maximum by 24. But endeavor is that in 23 season, which is mix of 23 as well as financial year 24 first quarter. So our endeavor is to bring to double the level at that month, by that time.
Okay, that's it. Okay, thank you.
Thank you very much. As there are no further questions from the participants, I would now like to hand the conference to Mr. Jeet Singh for closing comments. Over to you.
So with the growth opportunities we foresee on the domestic and export front, along with the government support, we believe we are well positioned to capitalize on this opportunity. And thank you very much, everyone, for joining us, and be safe and be healthy. Thank you. And I hope we have been able to answer all your queries. In case you require any further details, you may please contact our Investor Relations Advisors, Strategic Growth Advisors, SCA. Thank you.
Thank you very much. On behalf of Amber Enterprises India Limited, we conclude this conference call. Thank you for joining us, and you may now disconnect your line.